Welcome to Talk Tickers. Today we're jumping right into Ingersoll Rand's latest earnings call. Now, this one's a real head-scratcher. On the surface, it looks like they had a pretty solid quarter, but the stock's reaction tells a totally different story. It seems like the market picked up on something a little more worrying just beneath the surface. So let's dig in and figure out what's really going on here. So management kicks off the call, and they're projecting nothing but confidence. The message from the CEO, Vicente Renal, was crystal clear. Hey, our execution is strong, orders are growing, and our business model is as resilient as ever. The picture they painted was of a company that has everything completely under control, a steady hand on the wheel. But the market just wasn't buying it. Not at all. Look at this. The stock got hammered, dropping over 3% on some pretty heavy trading volume right after the call. And that, right there, is the central question we're tackling today. What caused this massive disconnect? I mean, if everything's going so well, why did investors just stampede for the exits? It's a paradox, and we're going to get to the bottom of it. Okay, so to really understand the market's reaction, we have to start with the numbers for the quarter they just reported. And this is where the plot thickens, because by almost any measure, the results looked, well, pretty darn good. In fact, they didn't just meet expectations, they actually beat them. All right, let's take a look at the key metrics here. Adjusted earnings per share, right in line with what Wall Street was expecting. No surprises there. Revenue? They actually came in a little bit ahead of the consensus, pulling in almost $2 billion. And their adjusted EBITDA? That was strong. So you see, this wasn't a miss, this was a beat, which means if the quarter itself was fine, the problem has to be somewhere else. And yep, you guessed it, that somewhere else was the forward-looking guidance. This is such a classic Wall Street story. The market doesn't care about the rearview mirror. It's staring straight through the windshield at the road ahead. And what management said about the future, that's what sent a chill down investors' spines. This slide right here really lays out the two completely different conversations that were happening. On one hand, you had management trying to keep everyone focused on the good stuff. Hey, look at our solid Q3. Our orders are resilient. Our balance sheet's a fortress. But the market, well, the market has selective hearing. It tuned all that out and heard something totally different. It heard a trimmed full-year earnings outlook. It heard tariff headwinds are now over $100 million. Yikes. And it heard about margin pressure in their main industrial segment, and crucially, that they're slow to pass those costs on through higher prices. So when you boil it all down, the key takeaway is simple. The past didn't matter. The stock's nosedive was a direct reaction to a cloudy future. The market punished the guide down, plain and simple, and all the ugly reasons that came with it. All right, so to really get our arms around these margin and guidance issues, we have to pop the hood and look at the company's two main divisions. Because right now, Ingersoll Rand is basically a tale of two completely different businesses operating under one roof. Okay, check this out. On one side, you've got their Precision and Science Technology segment, we'll call it P&ST. This division is the absolute star of the show. Revenue's growing, its profit margin is a whopping 30.8%, and that's up 80 basis points from last year. It's all being driven by strength in really high-value markets like life sciences. Awesome, right? But then, you've got the other side of the coin, the larger Industrial Technologies and Services segment, or ITNS. Organically, revenue here actually shrank by 2%. And look at that margin. It took a huge hit, falling 170 basis points. The main culprit? You guessed it, those tariff costs and lower volume. This part of the business is taking all the punches from the current economic headwinds. Okay, so now that we've seen the good, the bad, and the ugly, what does it all mean for the next quarter and beyond? This is where we get to our next call segment, our forward-looking analysis and our official take on the stock. So for Q4, our prediction is pretty straightforward. That margin pressure is going to stick around. Management was really clear about this. They said, yes, we've raised prices to try and offset that $100 million plus in tariff costs, but there's a lag. It takes time for those price hikes to actually show up in the results. In fact, they don't expect to see the full benefit until 2026. So what does that mean for the next few quarters? Well, it probably means muted margin expansion at best. And because of that whole margin story, our outlook for the stock price is, well, kind of boring. We expect it to be largely range-bound. The stock is probably going to trade sideways, stuck in a channel, until the market gets what it's waiting for. And it needs two things. First, some real clarity on what's happening with these tariffs. And second, cold, hard proof in the numbers that their price hikes have finally caught up with their costs. Until then, it's likely a waiting game. So, when you put it all together, it brings us to our official rating, market perform. Look, there's a lot to like here. Ingersoll Rand is a well-run company and it generates a ton of cash. But right now, all those good things are being canceled out by some pretty big headwinds. That macro uncertainty and the very real pressure on their margins. The risk and the reward just feel balanced. It's why we think it's unlikely to be a huge winner or a huge loser compared to the broader market anytime soon. Okay, and that brings us to our final and maybe most interesting segment. Given this really complex picture, is there a way to play this? Let's explore one potential trade idea that actually leans right into all this uncertainty. So, how do you play it? The core issue here, the thing driving everything, is uncertainty, specifically tariff uncertainty. And anytime you have a situation where you don't know the direction, but you think a big move could be coming, well, that points to a very specific kind of strategy. We're calling this one the tariff volatility straddle. Now, the thinking behind it is pretty simple. The stock's next big move is basically a coin flip, but the outcome could be huge either way. Think about it. If they get some kind of major tariff relief, that $100 million headwind just poof, vanishes. The stock could absolutely soar. On the flip side, if trade frictions get worse, it could get hammered. So the strategy here is to buy both a call option and a put option with the same strike price and the same expiration date. Your goal isn't to bet on which way it goes, but to profit from a big swing, whether that's up or down. Now, what's the big risk? Well, the risk is that nothing happens. If the stock just stays flat, your options slowly decay and you lose the money you paid for them. This is not financial advice.